Hello, everyone, and welcome to our inaugural Breakwave Day event. I am John Cardenas, founding and managing partner of Breakwave Advisors. Over the next 2 hours, you're going to hear views and opinions related to commodities, shipping, and supply chain, as well as maritime decarbonization from some of the brightest minds in the industry. Make no mistake, the last year has seen some of the most dramatic developments in all those industries, with significant disruptions, wild price swings, and government interventions that might be only a preview of what is to come for those sectors in the years ahead. At Breakwave, we always strive to provide as much information as possible to all investors from institutional-like sources and make such information that only professional investors used to have accessible and free to all. Today's event is part of such an effort, which combined with our publications and frequent updates should hopefully continue to add value to the investment process of such an exciting industry for all of us to invest and trade. Before we begin, I want to mention that this is a live event, so I would like to apologize in advance for any mishaps during this broadcast. So now, with no further delay, I would like to introduce our first segment that focuses on the current state of the dry bulk market, as well as the outlook for next year. So if you follow dry bulk shipping, you must follow our next presenter. One of the brightest minds in the industry, Nick Ristic has been a leading voice in the shipping markets and one of the most thoughtful analysts out there when it comes to maritime economics. So for Nick, as a lead analyst for Braemar, he has established himself as an objective voice in an industry that is generally characterized by lots of short-term noise or very long-term non-actionable forecasts. So with that, I would like to introduce Nick Ristic for Braemar. Good afternoon, Nick. The floor is yours.
Thank you very much, John, for that. Those kind words and very complimentary introduction. I think there are some slides that should be popping up any second. There we go. Thank you very much. So I'll jump straight into it. We've had that introduction, but just to kind of summarize. So I head up the dry bulk research here at Braemar ACM, and we're a global shipbroking company focused not just in the dry space. Of course, we do the physical shipping side and the derivatives aspect, but we're also covering the oil markets, tankers, gas, containers, etc. as well. But what I'd like to do with this presentation is just give a very broad overview of what we've seen driving this dry bulk market for the last year or so, and essentially where we see it heading, without going into too much, shipping specific jargon and terminology, so that it's a kind of accessible insight into our view. If you go to the next slide, please. Cool. So the thing I'd like to start off with is just a super long-term view of the dry bulk market. Here we have Panamax time charter rates, and we use these as a benchmark for the entire dry bulk shipping space. And what we've done is we've adjusted for inflation, obviously going back to the early 70s, and then overlaid on top of that you have the 1-year moving average and the 5-year moving average as well. And what we think that does a very good job of is illustrating the regular kind of shipping cycles that we're very much a believer in. You always have the kind of 3 to 4 year period of supply overshooting or undershooting underlying demand in the market. But on top of that, we've got these super cycles, right? So the most recent is, of course, the Chinese industrialization cycle between 2004, 2008. And then what we've had since then, right, in the decade following that, is essentially the hangover from that. So we had a lot of over-ordering of ships during that boom. We then had another spell of over-ordering in kind of 2013, 14. So 2016 marked the absolute low in terms of that broad, overarching cycle. And it seems like in the last couple of years, we're coming out of the tail end of that. And 2021 has really been when we've seen things finally pick back up. And that you can see that long-term cycle kind of flicking up, and we're looking towards, generally we like to say higher highs, higher lows going forward. So what we're seeing at the moment and what we've seen for the last few months, in our view, is a genuine, fundamentals driven improvement in the dry bulk freight space. And then on top of that, we've had a lot of COVID-related direct and indirect inefficiencies, which have also helped to add froth and push rates higher. And I'll go into all of those different drivers. So if you go to the next slide, please. On the fundamental drivers, we've got here demand for all dry bulk ships broken down by commodity. And in terms of the year-on-year changes, we can see which commodities have driven the recent growth. So in contrast to previous years where we've seen a lot of growth from things like grains, and then iron ore in the past has always been a kind of bedrock of demand. Recently, we've had a much more diverse picture, and that's especially the case when we look at the smaller ships. So at the high end of the spectrum, the largest bulk carriers, cape sizes, we've recently had a lot of demand growth from the coal space. And again, I'll go into the various drivers of that. But on the smaller ships, we've had a lot of growth in trade of commodities such as fertilizers, steel, both steel products and scrap steel, other minor ores such as nickel ore and things like that. So those have been the real drivers of this tightness. And if you go to the next slide, please. And on top of that, we've had some of those direct COVID-related issues that I talked about previously. So the most salient of those has been congestion, and here we've picked China just as an example of that. So you can see that for cape sizes, especially for the bigger ships, we've had really historically elevated levels of congestion, which is taking up at times as much as 5% of carrying capacity. And this is because of simply because of queues at Chinese ports where there's a lack of stevedores, for example, or pilots that take the ships into the berths, where they have to quarantine on on a rotation basis. So all of this just adds to the delays, adds to the congestion, adds to the inefficiencies, and helps to tighten that market. And that's been a real key driver of what we saw, push cape size rates, for example, up to 87 grand a day in October. Was this this layer of tightness in the Pacific. You go to the next slide, please. Another kind of indirect effect that we've had recently is, of course, we've had the strength in the container market, which normally you don't see too much interaction between dry bulk and containers. There's a few cargoes which cross over between the two occasionally, but with such a significant spike in container freight rates, we've seen a lot of cargoes recently crossing over and being shipped in the smaller bulk carriers. So, scrap steel is a good example of this, but we've also had, anything that tends to be shipped in bags, so fertilizers, coffee, that kind of thing, filtering up into bulk carriers. And that's evident when we look at our utilization models for the different ship sizes. And it's the smaller ships this year that have really pushed above everything else in relative terms. And that's partly why we've seen those ships more resilient in the last couple of months in how badly they've been affected by the correction that we've seen in the last few weeks. So this is something that we've been kind of expecting for a while. This tightness between the smaller and larger bulk carriers, partly because of where the demand growth is spread for those ships. But this is an element that we think will continue for the next few years, and it's going to be a recurring theme going through this presentation. If you go to the next slide, please. And of course, we've got to draw attention to the severe correction that we had in here. We've got FFAs, so freight futures. Over the last couple of weeks, we were pushing at extremely high levels, in going into October. And was there a single event that caused this sell-off? In our view, not really. It seems like the market kind of very quickly priced in a lot of the worries around Chinese economic growth, around things like Evergrande, which had been brewing for several months. But it was a very sharp move there, and now we've kind of stabilized a little bit and come back to more healthy levels. But this is just kind of setting the tone for where we are at the moment. The next slide, please. So moving to the bigger demand side stories, we've got here Chinese steel production. And this is really the elephant in the room in terms of the big risks to dry bulk freight going forward. I mean, Chinese steel production as an industry accounts for a third of all bulk carrier employment, right, across all of the iron ore imports and coal imports that go into that. And recently we've had some of the biggest declines ever in terms of the output that is being produced in China. Some of that is a politically driven cut to production, where, you know, for the first half of this year we were hearing consistently that the government was going to keep steel output flat versus 2020, and through that time we just had record levels of production occurring, and we didn't expect things to be quite this serious going into the second half of the year. If you go to the next slide, please. And as a consequence of that, we've seen the iron ore price come off significantly. It hasn't really affected iron ore volumes because the price is still high enough and significantly higher than a lot of the big miners' production costs. So they're still very much incentivized to pump out as much as possible in line with their production plans. But while steel capacity has been reduced, we had expected prices to increase because supply had been restricted so much, but that hasn't happened, and actually we've seen steel prices trend downwards as well. So there are signs that the demand picture in China in the last few weeks hasn't been very positive. There are some worries there, and really the turning point in our view will likely be in the second half of the year, once things like these, or the second half of 2022 rather, once things like, you know, the Winter Olympics are out of the way, but more importantly, a lot of the energy issues that China and a lot of other countries are having move towards being resolved. And so in the near term, we're expecting, you know, continued weakness in this space. Go to the next slide, please. But there has been some, you know, consequence on the upside to all of these shakeups in the steel sector, and that's particularly been the case for the smaller ships. So one thing that happened early on during COVID, where you had these very big cuts to steel production capacity globally, countries which recovered very quickly on the demand side were not able to ramp up production quick enough. And very quickly you have these arbitrages opening up where countries like the US have been having to import a lot more steel than usual because their own production hasn't, you know, increased to the extent that they can fill their own demand. And this is only more so the case, you know, with manufacturing running extremely hot. Construction picked up very quickly, and going forward with things like the US infrastructure bill and you know, the EU also spending a lot of money on stimulating the economy, these sort of things will help to build demand for steel, and it's likely to be met in some degree by imports, which benefit heavily the smaller ships, especially the Supramaxes. So you can see just that extra chunk of demand that's appeared for these ships basically as COVID starts. And this is one of the key drivers of why, again, those Supramax ships have done particularly well. Go to the next slide. Elsewhere, of course, coal has made a lot of headlines recently. You know, we saw a big decline in coal demand, both on the energy side and the steel production side in 2020, and we didn't expect things to recover this quickly, right? We thought that there'd be a gradual recovery in coal volumes before things eventually eased off kind of over this decade, but we've had a very sharp recovery. That's tied to a lot of the energy crises that we've seen in several countries, notably China. So if you go to the next slide, you know, we saw Chinese coal prices hit record levels a couple of months ago, and since then, you know, they've been hammered back. We're told that the situation in terms of coal shortages in China and, you know, global supply have improved, but actually the picture is not so clear. And, you know, especially in the Chinese case, in terms of stockpiles and production, we're still tracking at historically very low levels of supply. So this is a market that remains very tight. We think is going to stay tight through the next few months. Again, like I said before, those issues and energy demand, you know, starts to ease naturally as we get into the spring, summer. This is something that is going to continue to drive a lot of tightness in coal, and of course that sucks in more seaborne volumes and helps to tighten the fleet as well. And because you've had so many disruptions to the supply side, particularly China's ban of Australian volumes, we've had a lot of new trade patterns emerge, which have dislocated they've dislocated the fleet, and they've essentially meant that voyage lengths on average are getting longer. So we've got Australian coal traveling further than it did before, and we've got Chinese imports coming from further afield, like the US, like Canada and Colombia. So all of these things helping to tighten that market further. We go to the next slide. And of course, it's not just China which is facing these issues, and more this is gaining a lot more attention in the press. Is Europe, the UK, to an extent the US's energy shortages. And I've just got this chart here, which is very detailed. We'll go through all of the dynamics of it, but the takeaway here is that we've got the Dutch benchmark gas prices in red. And as long as that line is above the dark blue line, which is the theoretical price at which it is more profitable to burn coal over gas, as long as that window is open, we expect to see more coal being shipped into Europe. Do we expect a wholesale switch back to coal in these countries? Probably not. But for now, it does seem to be driving, a little bit of a reversal in that long-term decline that we've kind of become used to in these markets. So again, one more thing that's adding tightness to this market on the energy front. You go to the next slide, please. So the outlook for coal is very mixed. It's uncontroversially, we're not particularly positive on the next 5 years, the next 10 years. We think that a lot of the stated plans of the developed countries in particular to phase out coal will be followed up on, and we've already seen, on a long-term basis, big reductions in imports into countries like Italy, like Spain. But there are still kind of bright spots, if you're allowed to call them bright spots, for demand in other countries such as Vietnam until very recently, the Philippines, Malaysia. They're importing a lot more coal, and it's these countries still have plans to expand coal-fired capacity. These are all developing countries that essentially need this energy production to develop and grow economically. But a lot of this growth is very much focused on the smaller ships rather than the kind of traditional importers which use Capesizes, Panamaxes, those kind of typical vessel sizes for the trade. So again, this is another area where we're seeing a bit of a shift in terms of where the growth is within the dry bulk space, right? More growth on the smaller vessels rather than the big ones. Can you go to the next slide, please? And this is, so the previous kind of points have been fairly negative on ships like Capes, which are the largest ships in the fleet. But one area where we have been very positive on and continue to be positive on is the bauxite trade, which is the raw aluminium ore. And this is something that out of Kamsar in Guinea has grown from basically nothing in 2015 to a good 50 to 60, even maybe 65 million tons this year of trade, long haul trade that is all going to China. And these are tons that are all loaded offshore onto bulk carriers via transshippers. The whole process is very lengthy. The whole process is very slow, very subject to the weather. And because of that, it ties up the fleet for a very long period of time. If you go to the next slide, we've got a breakdown of Capesize employment by the different countries. And you can see just how important Guinea has become in such a short space of time. And in terms of how much ship employment is generated per ton of trade, that Guinea to China trade is even more important than Brazil to China, which is one of the big staples of demand in this market. So again, as that trade continues to grow, even though the tons are relatively small compared to that Australia to China iron ore trade, for example, it really has a disproportionate effect on employment, and it helps to keep demand strong over the next few years. Go to the next slide. So as I mentioned, on the iron ore front, we are, we see things kind of staying relatively flat along with those Chinese growth prospects, and we do see steel production in China recovering next year, and we see a bit of growth year on year versus what we've had so far this year. But longer term, the outlook isn't particularly positive, right? As we've got more scrap being used for steel production in China, more recycling activity. Similarly, on coal, the outlook isn't particularly positive there. But where we're very positive on within these different commodities here is obviously on the grains and the minor bulk space. And I split out bauxite, which is again tied to that Guinea story we were just talking about. But the grains have been consistent drivers of trade growth for the last few years. Even through the COVID period, we've had 2 record levels of trade and employment. And again, on the minor bulks, things like steel, which I mentioned before, these are all things that are tied to economic growth across virtually all countries, right? So it's not we're not exposed to a single country driving this growth. We're not exposed to a single market. It's all very diversified sources of demand that are when we look at which ship types are exposed to that, it's again obviously the handy supers and to an extent the Panamaxes that are gaining the most from that. If you go to the next slide, please. So that's a very broad overview of the demand and where we see those going. But what is possibly more interesting, for the next couple of years is actually the supply side and how big the fleet we think will be for the next few years. If you go to the next slide. As I mentioned, we've had this period of the last decade of huge amounts of over ordering relative to what the demand has been. But going forward, that just isn't the case anymore. We've had so far, relatively small numbers of orders being placed despite how high freight rates have been. And actually the growth prospects for the size of the fleet are still very limited. If you go to the next slide, we've got a breakdown of just how much has been ordered. And as a percentage of the size of the trading fleet today, we're looking at only 7.5% on the order books. And that's on the order books all the way out to 2023, 2024. And that figure is virtually locked in right out to the second half of 2024, potentially even 2025 if you're looking at ordering a new ship. Why is that? Well, we've had so many container ships being ordered, also gas carriers. There's still a lot of tankers on order. And what that means is that we're in a very constrained supply situation going right the way through to 2024. And what that means is, although we're probably more conservative on the growth of demand from commodities like iron ore, like coal, there is this fundamental floor to the market provided by this low supply growth. If you go to the next slide. So plugging in all of those numbers, we look at, on the demand, we've got all of those commodities being brought together to give our demand curve on the left, and supply as well. Low supply growth means that although we see 2021 as the kind of peak of this cycle in fundamental terms, we're not going particularly low through 2022, 2023, and we're going nowhere near the kind of levels that we saw in 2016, which represent those absolute kind of trough levels of rates. But one thing we haven't talked about too much is the regulatory side of things, and in particular the efficiency regulations, which are coming as soon as early 2023, and we're only 12 months virtually away from these starting to have a material impact on the market. You go to the next slide, please. We don't have too much time to go over the specifics of the regulations and exactly what they mean for each kind of ship, but essentially EEXI is the one that we think is going to have the most impact. And what this is an efficiency regulation that essentially means that every ship will have to comply with a certain technical level of efficiency. And to kind of quantify the impact of this on the market, what we've done is assume that the only material way that the inefficient portion of the fleet can comply with these regulations is to effectively limit engine power. And there are, in reality, a few other things you can do, like install new propellers, install bulbous bows. In extreme cases, we've had the rotor sails and things like that. But if we assume that all else being equal, just those inefficient ships have to slow down from where they're currently steaming at, which in some cases is only half a knot, maybe 0.75 of a knot. We've modeled what that does in our forecast to that supply and demand balance. If you go to the next slide. So you can see that from 2023 onwards, this has a really significant effect on our supply curve. And we've got that basically chunk of capacity being removed, which, in the Cape fleet, for example, it's the equivalent to taking out 65 ships. It's, we've got the equivalent figures for the other sectors. And you can see that in terms of our utilization, we're picked up almost close to where we are or where we have been on average this year. So this is how serious the effect can be from what is, in our opinion, a very small change in speed for just one portion of the fleet. So if you go to the next slide, just this is some of the technical figures there, just on, again, if you plug in those speed changes, what you get in terms of the numbers of ships being removed from the fleet, but you can have a look at those after. The next slide, just to finish off. So, broadly speaking, as I said, we're not hugely bullish on commodities like iron ore in terms of trade volumes, and the same goes for coal, where longer term we don't really see where the growth in demand is coming from, on the same scale that we've been used to for the last decade. However, we are still very positive on the minor bulks, on the grains, and really the driving force and the thing that we think is gonna pick up that blue line, that kind of super cycle moving average for the next few years, is that limited supply growth, where we just have so few ships on order, and we're finally getting over that oversupply that we've almost become used to for the last decade. And of course, food for thought at the end there, that EEXI issue, which could throw a real spanner in the works to this normal cyclical pattern that we've become used to, and as I said, bring things back potentially to where we've been on average for this year. So thanks very much. I'll hand over to the next speakers, and thank you for your time.
Thank you very much, Nick. That was extremely interesting. And I think it's very useful to see how the people who receive real-time information from shipping and commodity markets think about the outlook versus a lot of shipping and commodity analysts that process such information on a second-hand basis. So thank you again, Nick, for your time and insights. And we'll be back with our first panel of the day in 15 short seconds. Welcome back. Our first panel of the day also contains some of the leading voices in dry bulk space that also receive and process first-hand information, and thus can speak about their views and outlook for the dry bulk shipping as they see it from their respective positions. So today, for our dry bulk panel, we're very excited to have with us Angelica Kemene, co-founder and CEO of Optimax, Peter Lindstrom, who is the head of research at Klaveness, Rahul Kapoor, who is the global head of research and maritime and trade at IHS Markit, and Stamatis Tsantanis, chairman and CEO of Synergy Maritime. So let's jump straight into our discussion. And my first question is for Peter. And I think, as you heard Nick's outlook for 2022, although he talks about 2021 being kind of the peak, and that's kind of understandable with Capesize rates at almost 100,000. One thing I want to talk about is that 60 or 65 days ago we saw Capesize rates at almost 100,000, and it has been some like 500 plus days, when we saw Capesize rates in the single-digit range. So it has been a very wide range. And again, I talk about the large Capesize ships here, but I want to hear your thoughts. What do you think is the risk of next year, again, dropping down to that level? And on the other hand, can we see a repeat of 2021, and why this you think is going to happen?
Yeah, that was several questions. I'll try to answer them in one go. First of all, I agree much of what Nick was representing, so he gave a very good overview, but I can maybe add some flavor on some dimensions. Looking to 2022, what we know will be right is the nominal fleet growth. We know we're going to be at all-time low levels. And then, well, we also have effective fleet growth, meaning what's the actual carrying capacity of the fleet? And to reach that, you also have to look at the congestion and speed. If we look on congestion, rightfully, as Nick said, we have seen COVID pulling up congestion. But I believe it can go either way in 2022. If you look through how congestion evolved in 2021, it wasn't particularly high in the first half of the year. When we got into Q3, we had very high congestion, but now it's eased off again. We are actually at perfectly normal level if you look on congestion as a percentage of the fleet as of today. So that's the starting point. Should we move higher or lower? Well, that depends on what happens on the COVID side of things. As for now, China is maintaining their zero tolerance for COVID, meaning that as of now, strict rule imports will be in place. If this eases up, that will lower the congestion and that can bring the effective fleet growth slightly higher. However, if COVID loses its grip on the world economy, then that will be positive on the demand side of things. Then the second factor that will impact the effective fleet growth, besides congestion and nominal fleet growth, is speed. And right now, through Q3, we saw speed being basically at maximum speed. So from here, the only way for speed, in order to also reach those environmental targets kicking in 2023, is down. So it's very likely that effective fleet growth will be even lower than the nominal fleet growth, in my view. And that puts a solid foundation for rates in 2021. And then on the demand side, there are two big uncertainties. One is clearly linked to the real estate market in China, and the other one is a new strain of COVID, which leads to high hospitalizations and lockdowns to a larger extent than in 2021. I think that's unlikely. So the COVID scenario, I think, is a high impact, a low likelihood scenario, while a weak real estate market in China continuing is much more likely. If that happens, it should lead to lower iron ore demand and lower iron ore prices, basically. But if you look at today's iron ore price, it's well above the marginal production cost of the seaborne exporters. So at the current spot rates and the current forward levels for iron ore, all seaborne exporters, except those at the very high end of the cost curve, are incentivized to ramp up their exports. So I think iron ore shipments will be resilient in 2022, but the growth will not be that big either, but it will exceed the very low fleet growth. And I think you can say exactly the same on the coal side of things. It's restricted by supply, not demand. We're going to see demand growth, fairly low demand growth, but it's going to exceed the very low nominal fleet growth. So overall, next year looks supportive in my view. And I definitely think we can see pockets where we see utilization going as high as we saw for the Capes in this year.
All right. Raul, what do you think? I mean, as you look 2021 versus 2022, what are your thoughts?
Thanks, John, for having me. So I think I'll totally agree with what Nick said as well as what Peter maintained, right? I think something which we are closely watching is what you call the Chinese COVID zero policy, right? If you take out the congestion from the market this year, we would expect the rates to be 30-40% lower than where they are. right? We're talking about multiple lockdowns, regulations. All of these things are keeping the effective capacity lower. So congestion aside, I think the second thing which we are also watching clearly is, and this is much more longer term, it's not a 3-month trend, but what's happening with Chinese fixed asset investment, Chinese real estate market, right? It's the key driver of the dry bulk market. The last 20 years have been pretty solid for these seaborne demand drivers. But if we go into a flux for the Chinese fixed asset investments, real estate over the next 3 to 5 years, that maintains a clear risk to this dry bulk market. Overall, fleet growth certainly very muted, very, very constructive on that side, as earlier Nick as well as Peter mentioned. So 2022 will be another strong year, but we would expect overall rates to be lower than what we've had this year. So not expecting the capes to shoot up to where they went if we take out the congestion. But again, as we know, and this is a perfect setting, we can call it, we are still in the midst of a pandemic, right? The new variant, how it evolves, what actually happens with that will determine. So the market would be volatile, another strong year in 2022, but rates should slightly be softer than what we've had this year.
All right. Another interesting thing, very quickly for Peter and Raul, first for Peter, if you look at the futures market today, there's a very odd situation where the large Cape-sized vessels, which carry iron ore and coal, are basically predicted to earn the same amount of money with the smaller ships that carry a wide variety of goods. And they're like, 3 or 4 times smaller than Cape-sized ships. Do you think that's accurate? Is it possibly we see such a scenario next year? And why you think this is happening?
Yeah, sure.
Peter.
Yeah, let's start with
Go ahead.
Peter first.
Yeah, so starting with the Cape sizes, 70% of what a Cape size carries is iron ore. So the direct link between iron ore and the Chinese real estate market is clearly most pronounced for the Cape market. And it's that risk that's pricing in the forward curve. So that's why the Capes are relatively cheap to the other segments. Another factor is that the forward curve at any given time is also heavily impacted and influenced by the current spot rates and what we've experienced recently in the spot rates. And if you look through this year, I mean, all segments have been strong, but on a relative basis, it's been the smaller sizes which has been the outperformers. So that's also carried on into the forward curves.
So, just to add,
yeah,
just go ahead, Peter. You wanted to add?
Yeah, so just to finish, so I take a slightly more, I don't think Chinese real estate demand or Chinese steel demand in general will remain muted as they are today throughout 2022. I think definitely as we move past the Beijing Olympics, I think steel production will start to pick up. Right now, we're seeing the gross margin from steel production in China increasing. There, it's actually at a good level. So steel producers are incentivized to ramp up their production. So I do think demand will be there, and definitely I think seaborne flow of iron ore will be there. So the market is pricing it because of this risk, but I think seaborne volumes of iron ore will continue to flow. So I think the spread between the larger sizes and the smaller sizes will increase.
Just to add there, I think Peter makes perfect sense here, right? So Cape size, in that sense, forward curve is a macro trade on what's happening with the Chinese domestic economy, right? Whether it's the fixed asset investments, real estate, or the housing market. So that is where people are worried and genuinely worried after what we've seen in the recent months. The housing stats had been horrid, right? You're talking about negative year-on-year growth. So that's a play which is happening on the Cape size. I think the most interesting part, which you alluded to, John, is the similar FFAs for all the asset classes, right? That's very highly unusual. A key part of that is the distorted container shipping market, right? That market remains highly distorted at this point of time. Nobody would have said start of the year the rates would be here, right? So we've seen some of, and Nick alluded to this earlier as well, the knock-on effects of the distorted container shipping market on the smaller segments. They've never been so correlated, but the smaller segments, we've seen a number of vessels actually carrying the containerized cargo. The backhaul has been very, very strong. So that's playing into the smaller segment, Supramax as well as geared bulkers market as well. And we do expect those markets to stay strong. I think our expectation of the container market next year is still pretty strong. I think the rates would start coming off, but they would stay elevated and they'll continue to play in the geared market as well as the Supramax segment as well. So overall, the market for the FFA curve would stay distorted for some time in the future. I would say probably in the second half of next year, it should start normalizing, but early part of next year, we would still see the smaller segments command a much higher spread than what they've done historically.
All right. So I would like to move to something else that a lot of people are not considering their outlook. So it was interesting, Nick's view on that, and I think we're going to hear much more about that in next year, maybe in the years ahead, and it has to do with these 4 letters, EEXI. So I would like to turn to Angelica and Stamatis for that, and first to Stamatis. Obviously, you're an owner of ships, of Capesize ships, 17 of them, and this is something that is quite concerning or an opportunity for next year and the years ahead. First, can you please give us a very brief explanation what EEXI is? And second, how do you think about that when you think about the outlook for the Capesize segment, for example?
Of course. Thank you, John, and thank you for having us today. I think it's a great idea and a great get-together of people to educate the market about, some very key things about seaborne transportation of raw materials such as iron ore, coal, that might seem to be exotic for some of the audience, but are very key to the global infrastructure investments happening in many countries, including the United States. So the EEXI is effectively the same first big measure that is going to happen for the new environmental regulations that are going to kick in 2023. And this is not a one-off thing. I mean, this is something that will be progressively accumulating until 2030 and then until 2050. So it's the first big measure, which what it is that a big portion of the global fleet right now will have to slow down. And the reason why it will have to slow down is that the IMO will need to impose restrictions on the CO2 emissions of the greenhouse gas emissions of the ships. And that's the first big measure that is going to happen on the existing fleet. So the existing fleet will likely have to slow down from its maximum speed anywhere between 15 and 20%. So that is in effect. I mean, it's an immediate speed reduction of the global fleet. That's what it is. Now, what it will actually reduce is the maximum speed. And the question here is whether the ships are actually running with a maximum speed or they don't. So it's like a highway where you have a maximum speed of, let's say, 200 miles per hour. And, you're just reducing that to 120. And the thing is that, is anyone actively running above that speed limit? So in our opinion, the answer is yes, and it's going to affect the fleet significantly. And I fully echo what Nick said before about the impact that this is going to have on the effective supply of ships. So there's going to be a major impact. And it's not going to be only the immediate effect that it's going to have on the fleet, but also it's the start of many things to come into the future in respect of speed reduction, and greenhouse gas emissions, and most importantly, it's going to be the first big step in reducing the effective supply of the vessels, which, in our opinion, is going to be super major for the dry bulk industry and especially for the Capesizes. Now, if you look at the projections of whether the EEXI is going to have a 6% real impact or an 8% real impact or a 10% real impact, our answer to that is it depends on the type of ship. Obviously, in the smaller ships, if you're running a Supramax or a Panamax, a 20% reduction on the maximum speed might not be super impactful because these vessels do not have as many sea voyage days as the Capesizes do. If you look at the global fleet on a deadweight adjusted basis, which is on a size adjusted basis, you will see that the bigger ships are usually having more days in the water, on a sea voyage days, and also they're running at higher speeds. So the deadweight adjusted, which is the tonnage adjusted speed reduction on the larger vessels, is actually going to be much, much greater than the smaller ships. So that's why we expect the effective fleet supply, especially on the bigger vessels, to be much more impactful than the smaller ships. I hope that answered the question, John.
No, it does. And I want to make sure that people understand that this is something that it doesn't affect only dry bulk, but it will affect all commercial shipping, whether you talk about dry bulk tankers or containers. So when you think about that, you have to think about what's happening today, for example, in California with the congestion, what's happening, in all the ports around the world. So it's important. So I want to turn to Angelica and ask her how she thinks about basically these environmental regulations when she thinks about her outlook, not only for 2022, but maybe even further out. How will that play in your outlook?
Actually, it will start to play a role in my outlook later, towards the end of 2022. And there are many reasons for that. It's not only slowing speeds, because some owners might not choose to slow speeds that much because of the charterer's choice, but there is a mix of regulations coming into effect, such as the WEXI, as you mentioned, and then the CII, which is much more operational, and maybe country by country level regulations, such as the EU ETS, that will add to bunker fuel costs because of the carbon taxes. And I think that ship owners will need to start thinking about their return on investments, to either scrap the vessels or continue with retrofit investments or new fuel, new buildings actually with new fuels, if and when they are available for the new buildings. And of course, after 2024, because the yard utilization is high.
All right, since we're in that subject, obviously rates are very profitable across the dry bulk space, especially for smaller sizes. So back to Angelica, you're talking about the new building program. It's very interesting that people are not ordering new ships. It makes sense from what you say. Do you think that given the profitability today, that will accelerate, or we're gonna go to next year with a similar low order book?
I don't think that it can accelerate, to be honest. In general, the expansion of the world fleet, containing all vessel sectors, is expected to level off in the years to come, and the global order book represents about 10% of the global fleet. So for the dry bulk carriers, other oil tankers and chemical tankers, they are all due to take delivery of more than 2/3 of their order books by year end of 2022, while the container and the gas carriers will take most of their deliveries in 2023 and 2024. On the other side, as I mentioned before, the yard capacity has fallen and the yard utilization has increased, which is something like close to 80% for the first tier yards and close to 45% for the second tier yards. So we know that the first tier yards will not be able to accept new orders, as they are projected to be able to empty their order books later, after 24 months from now. So the delivery times have increased, and the dry bulk carriers at top yards will be able to be delivered more into 2024 onwards. So in addition, the dry bulk carrier fleet is relatively young and averages around 9 years old, and the freight environment, as we all said, looks good and healthy at the moment. That will be the case for 2022. So congestion might be there also, and the expansion of the minor bulk trade. So as long as we see profits from all those factors, I don't think we will see a meaningful upside of new contracts for at least the whole of 2022.
All right. Yeah, I think that makes a lot of sense. I want to turn back to Stamatis on a broader question about infrastructure. And obviously we talk about here dry bulk and rates and so on, but global trade has been growing something like 4 or 5% a year in the last 20 years. Today we have tens of container ships stuck in outside California. We have delays in ports around the world, even in Europe, in China, and so on. Do you think that the port congestion we're seeing today is just a blimp, or you think that the infrastructure around shipping is old and needs to be, redone given what's happening with global trade?
John, this is actually a great question, but it's not only about the port infrastructure. The ports are, pretty much an entry point of the commodities or the raw materials or the containers into a certain area. I mean, you have to think that the overall logistics network is pretty much old, and that needs to be, surely that needs to be improved. As far as Capesize trade is concerned, which is basically iron ore and coal, to the extent that we feel that some of the tonnage has been absorbed by congestion, in 2021 on the Capesize segment, we didn't really see any material increase in congestion on our ships. I mean, we had pretty much the same turnover time in most of the ports that we're using, like we used to have. So congestion was not so much a factor on the Capesize segment. Maybe from time to time we had a few extra days here and there, but we didn't really see the congestion effect as everybody was talking about congestion on the Capes. Surely there is a lot of congestion on the containers, there is a lot of congestion on the minor bulks, grains, there's a lot of congestion there. But on the Capes, we didn't really see such a big spike of congestion as people have been talking about. So we didn't really see that. On the contrary, not only congestion was pretty much the same, but like Peter said before, the overall speed of the fleet increased significantly, especially in August and September, by about 2 knots, which is a huge increase in respect of speed of the vessels. With the new environmental regulations, I'm going back to the previous point of the EXI, when a market spike happens, the charters will not have the ability to instruct the ships to run instead of 12 with 14 or 15 knots, because the vessels will not be allowed to run so fast. So, having that in mind from 2023 onwards, when there is a supply squeeze into the market, which means that there will not be enough ships to transport the underlying commodities or raw materials, the vessels will not be able to speed up to the extent of their maximum speed like they can today, and they could, especially now in September. So please have that in mind that, supply squeezes into the future will be much worse than what we experienced now. And about congestion, I think I gave you the answer. I mean, we didn't see that so much in Capes, but we know that it is a big issue on other sizes and containers.
All right. Obviously, as in every panel, you cannot close it without getting everybody's outlook here. And this year on the large Cape sizes that carry iron ore and coal, probably average rates are going to be around 30,000 maybe. Last time we saw that was 2011 or 2010 actually, so a while back. And today the futures are priced at around 20,000 or 50% lower for next year. So I want to make a round of everybody and see what you think about this outlook. Do you think that, and again, I'm taking the Cape sizes because they're the large and most focused ships out there on the dry bulk space. So I will start with Peter and ask you, do you think 20,000 is a fair price? What is the likelihood of higher and what's likelihood of lower for next year?
Yeah, so actually pricing in December, we're looking at 33,000 for this year and 22,000 for next year. So that's quite a steep backwardation. And as I said, I think demand growth in general will exceed fleet growth next year. I think we're going to have demand growth higher than 2%, which is basically where the fleet growth is. So if not exceeding, I definitely think we're going to get close to this year. So I'm definitely a buyer of that curve.
Raul?
Yeah, I would agree to Peter. I think marginally lower than where we were this year, but I think 20,000 is I can't say cheap, but I think we have upside to that. Yeah.
And Angelica?
I would think that 20,000 is on the lower side. I would guess somewhere close to 22 and 23K for the Capes next year.
And Stamatis?
Well, in our opinion, I don't think we will see lower average for the year in 2022 than we did for 2021. And year to date, we have about $33,000 for the Capesize segment. I don't see that in the next month going down to below 30, so I find it impossible. So if I have to pick a number, I would say $33,000 to $35,000 as a Capesize average for 2022.
And do you think that what do you think the ranges will be on the Capesize, for example? We had a very volatile year this year. You went from like something like I think 10,000 or 12,000 all the way to 100,000 and back. What do you think? We're gonna see the same range, or is it gonna be tighter? What do you think? And let's go back, Stamatis first.
I think we're pretty much going to see the same volatility in 2022 because the regulations will be there. Although the CII of 2023 will be the first impactful year, so 2022 will have to have in mind the average speed and how that is going to affect the CII of 2023. So, in my opinion, I think we will pretty much see. I don't believe we will see lows of $12,000. I find it extremely unlikely. I think the range will be somewhat smaller. So I would say between 20, 22,000 on the lower side and maybe 60, 65 on the high side. But surely the average is going to be, like I said before, above 30, in our opinion.
Angelica?
What? Because I was questioned before the same question. Should I comment on what Stamatis thinks?
What? Yeah. No, I'm saying like, what do you think the range will be this year on the Capes?
This year, like 2021 or 2022?
Sorry, 2022.
I thought I answered just a while ago. So
the highs and lows. That's the
highs and lows.
Oh, the highs and lows. I would say a low 15K up to 35. So the range.
I see. Raul?
I'll expand it. I think probably around 20 to 60. Yeah, more on those lines. It will be tighter than this year. Yeah.
All right. And Peter?
Well, yeah, generally speaking, I think maybe it will be tighter. We have this underlying seasonality where iron ore volumes is lowest in Q1. So I do expect that to be the weakest quarter this year as well. And we have some weakness right now on the demand side as well with China. So I definitely think we're going to see a relatively weak Q1, but not as weak as last year. And then I think as the year progresses, things is going to become better and better. And yeah, I think we can actually see the peaks we've seen this year and maybe even higher, because I think overall utilization will increase.
All right. Thank you, everyone, for being so brave and putting the numbers out there. Obviously, thank you very much for participating in that, and especially Raul for staying up late for that day. It was a very interesting discussion. And we'll be back in a short 15 seconds with our commodities panel.
Excellent.
Welcome back. So our next panel focuses on commodities. Over the past year, commodities have been front and center in the investment world. As inflation has been on the rise, global stimulus remains very accommodative, and supply chain issues continue to push prices of certain commodities to very high level in this process. When you think about commodities, you have to think about shipping. They go hand in hand, and whoever focuses on one industry cannot disregard the other. The outlook for commodities remains promising to us as the structural issues that have pushed prices higher remain in place. We would like to hear more about the drivers and the outlook for commodities, and to that extent, we have with us an excellent panel of experts. So for that discussion, we'll go to Athens and my colleague Thanos Ophios, who will introduce and moderate the next panel on commodities. So good afternoon, Thanos, and please go ahead with your guests.
Thank you, John, and welcome all to our commodities panel. We are glad to have with us people from the industry that will provide us with their views on the current state of the commodity market, as well as their outlook for next year. Commodities have seen one of the best years in recent memory, as a combination of strong demand and restricted supply has pushed several commodities to record highs throughout the year. From iron ore, coal, to grains, the bulk commodities that impact shipping demand have experienced wild price swings, raising significant concerns as related to underlying inflation, energy security, and food availability. Today, we are joined by three distinguished guests who have followed these markets for many years and on a daily basis are focused on every aspect of these markets. They will help us understand a bit better what's going on in these markets and what the outlook for next year looks like. So our panel today includes Elena Maximenko, Senior Analyst Coal and Steel at IHS Markit, Tom Fox-Hughes, Sales Manager Energy and Commodities at TP ICAP, and Joel Parsons, Portfolio Manager at Greywood Capital Management. By most measures, 2021 was the year of commodities, especially when it comes to bulk commodities. Iron ore reached record highs, coal rose to the highest in at least 11 years, and grains also saw sizable increases in prices. The question is whether this is going to now correct and revert down to the historical mean, or are we in a new era? Each commodity has its own drivers, so I think it's better to approach it separately. First to Joel. Joel, iron ore has an exceptional performance up to May, followed by a spectacular collapse. This is now history, and without disregarding the past, how do you see iron ore prices developing in 2022?
Thanks, Thanos. I think prices will come down to two things. And so to begin with, I think in the long run, it's going to come down to supply and demand. We have seen that mostly in the last few months, but since the beginning of January, iron ore port stocks in China have grown by 30 million tonnes. And we know that Chinese policymakers are directing the industry to produce the same amount or maybe less steel in 2022 as they produced in 2021. And we know that the major iron ore producers, at least, are not looking to reduce their production. So from a global perspective, looking at the full year, we can see that there's probably remains an oversupply and some pressure on iron ore prices. But within that, we can see that there's a lot of potential for volatility through 2022. Stocking and destocking cycles in this market can be quite violent and quite vigorous. We have natural seasonality in Q1 around cyclone season in the Southern Hemisphere. We have issues around production cuts that will be enforced through to the end of the Beijing Olympics. And then we have uncertainty around, regardless of what the annual production quota is for steel in China, we have uncertainty about how that will actually be applied throughout the year. So one open question is, after the Olympics, will the pressure be taken off steelmakers and basically they can produce as much as they like for 3 months, and then in July there'll be another crackdown on production levels to kind of use the second half as a balancing item to ensure they don't overrun their target by the end of the year? If that's the case, Q2 could be very strong for iron ore prices, and we see as the DCE flirts with contango, so it's now in a 10 RMB contango between January and May on the Chinese futures. So we see that the market is pricing in that there's a good likelihood Q2 could be much stronger than Q1. And so the volatility within the year, I think, will be quite interesting. It won't be a one-way trend all year long, but it's hard to see that China doesn't end 2022 with higher port stocks than it begins. So we should see, I think, an average price closer to today's level than to the higher levels we saw earlier in 2021.
Thanks. That was very insightful indeed. Coal had also a spectacular year, And so once again, this was followed by a collapse, but from extremely high levels. China remains the main consumer of coal, and similar to iron ore, government regulations and intervention are basically driving prices. Elena, turning to you and your views on commodities and maybe coal. Do you think this year was an outlier? And how do you see coal market in the near term? We all know the global efforts to reduce dependence on coal, but for the next 6 to 9 months, the investment horizon of a lot of investors, what do you see as the main drivers for coal?
Hello, Tanas, and thank you for your question. This is indeed, we've seen a very interesting coal market this year. The coal prices in Northwest Europe and in South Africa both touched 13 years highest in October. So the price just skyrocketed to 260 on the CFR basis, up just from around 66 in January. This is all were driven by lower supply issues in Russia, which is one of the biggest supplier in Europe, as well as gas prices, which were fluctuating at record high levels. Both of that factors basically just forced electricity generators to use more coal in their generation mix. And all of that just show us that coal is still a pivotal part in energy generation globally, because that situation was not seen only in Europe, but in Asia and America as well. So just let me quickly turn to what we're seeing next, because after the COP26 summit, withdrawal from coal is rather a hot topic elsewhere. So the final agreement after the climate summit keep calls to end public financing for fossil fuel. So the British host jumped a deal on shifting away from coal, which was signed by more than 40 countries globally. And however, the deal was avoided by the key players in the market, which includes China, India, US, and Australia. So far, China, India, which is both related to the biggest coal consumers globally, just making last-minute demands to amend the coal from phase-out coal to just phase-down coal. The demand is still going to be there in the near term, and coal are just far from being history, right? So far, what was the main points and the main results after the climate summit is to end all investment in new coal power generation, domestically and internationally. Major economies has agreed to phase out coal by 2030s and the poor nation by 2040. And those organization has also signed up to the pledge, with several major banks agreed to stop financing coal industry by the end of this year. It means 2 new coal projects and development coal project as well. So to sum up, the trajectory for coal demand from now and onward are clearly to downhill. However, the main question here is, does COP26 really change the near-term outlook for coal? And the quick question is probably not, because this is not just an issue of financing, but this is a question of physical limitation of existing power units to adapt to more renewable heavy power system. And this is a lack of scalable technology that help to assume stable power supply. This all suggests that for many markets, coal will remain an important part in the energy mix, at least through 2030. So means at least in the next 10 years. However, what was interesting to watch in the next several years is after the COP26, the countries agree to review annually their promises and their plans to phase out coal, which means that the pressure to phase out coal will be extended over the next years. And it's going interesting to watch how is it going to develop in the next several years. Are the countries going to keep their promises to phase out or at least phase down the coal?
Thanks, Elena. And can we also get your views on iron ore and steel? Are these markets in a structural bull market, or 2021 was an outlier again? How do you see this developing from here, and what are the key drivers you are watching?
Okay, so basically the steel market is driven by the same factors as coal market as well. So we see the production slowdown during the COVID restriction last year, and many of steel producers all around the world just getting back online slower than expected, which all lead to a large price fluctuation over the year. What is interesting to watch over the next years is, not surprising, basically, the transition to the green steel technologies. Because many countries right now has started to implement regulation in favor of increasing of consumption of green steel, in favor of reducing green steel emissions. And the transition requires a lot of investment in green steel technologies, as well as carbon payment, which will be definitely mirroring and increasing the production steel costs. So far, the European Union has recently announced that carbon border adjustment mechanism that would oblige importers of steel products, among the others, to buy so-called carbon certificates starting from 2026 and to pay for the carbon emission. And so far, the carbon prices is around 70 euro per ton of CO2, which is related to the huge increase in cost of steel producers. That would mean not only the extra costs, but this is all can change the steel costs all around the globe, as the green steel would be against the steel produced in like more immediate way. So if we go back to technologies, the company right now is investing in development of green hydrogen technologies, as well as trying to switch to more high quality raw materials, like highly ferrum content iron ore or other like DRI technology and etc. It all requires investment, but implementing this technology will just ensure that the company will stay competitive on the market.
Right. Thank you, Elena. Joel, back to you. Brazil has been a constant disappointment when it comes to iron ore growth. Year after year, we hear about growth, but we are back to early 2010 levels in terms of exports. Do you think there are structural issues, or there is a natural tendency to react to prices? Vale has for years been talking about 400 million tons per year production target, only to being pushed back. Is that realistic?
It's a very interesting question. I mean, Vale volumes peaked in 2018 before the second dam collapse in Brazil. Yet since then, their revenues have done much better than they did in 2018. So I think you have to look at the management incentives, and no one in Vale management wants to see a repeat of the tragic dam collapses that we saw in 2015 and 2019 in Brazil. So there's no incentive for them to relax the focus on health and safety in order to achieve volumes. But I think you also need to look at the economic incentive, which is that Vale revenues have been higher at lower levels of production. And in an iron ore market that is not far from balanced, if Vale had produced at 400 million tonnes a year since 2019, their revenues would have been a lot higher. Iron ore market has been just a little bit in deficit, but if Vale was to reach its production targets, it would have a small surplus every year, and revenues not just for Vale but for the whole iron ore all the iron ore producers would be much lower. So I think Vale has important reasons because of their stakeholders in China and because of anti-monopoly regulations around the world that they can't come out and say that they are managing supply to maximize revenue. But in practice, if you look at their behavior, they have very little incentive to push additional volumes into the market and potentially reduce the unit price for iron ore.
Thank you. Thanks, Joel. I now turn to Tom. We'll cover shipping decarbonization extensively in our next panel, but decarbonization in general will be mineral intensive because the energy transition, the clean energy technology, requires substantial amounts of metals such as copper, nickel, cobalt, and lithium. Are these metals a key bottleneck?
Thanks, Thanos. As you say, the energy transition will be hugely infrastructure intense and therefore very metal and, in this case, mineral intense as well. Looking at things on a slightly longer term horizon, currently 80% of the world's energy demand is met by coal, gas and oil. By 2050, energy demand will be 2.5 times higher than it is today, but the world is committed to that energy production being net zero. So the infrastructure investment to get to that is huge. At present, the world produces 3,000 gigawatts of renewable energy. By 2050, this will need to be 26,500 gigawatts per year. So this means a 20-fold increase in solar production, an 11-fold increase in wind production over today's levels. We're also targeting a production of 55 million electric vehicles per year by the end of this decade, which is 18 times more than the current levels. So there's a serious question around how this is achieved. And copper makes up a massive part of that solution. And as we move towards that renewable future, power grids are going to require massive amounts of copper to upgrade and to be able to sustain a sort of slightly more decentralized grid. And EVs, talking about those big numbers there, they require about 5 times more copper than a traditionally powered vehicle. So current copper consumption is about 30 million tons per year. And to achieve what we're talking about by 2050, copper consumption will get to around 60 million tons per year. So that's a 1 million ton per year growth over the next 3 decades. Annualized production over the last 10 years has grown at 500,000 tons. So there's a big deficit to be addressed there. Nickel will also play a big part of this energy transition solution. That's currently consumed at a rate of 2.5 million tons a year. That will need to get to 9.2 million tons a year by 2050. So 250,000 ton per year of extra supply needed. And over the last 10 years, that supply has grown at 100,000 tons a year. So again, there is a big bottleneck there that needs to be addressed. The situation is the same in cobalt, it's the same in lithium, it's the same in other key elements and metals that will drive this transition. So it's plain to see that without significant sort of supply side change, there will be major shortages. There are new mining projects coming on and there are new mining projects planned. However, these are not really in easy to reach and easy to develop locations any longer. Most of the easy production available in the world is in the market already. So additional supply will have to come from unstable or politically unstable countries, countries with poor infrastructure. And when you think that a normal sort of mine sort of delivery time from inception to production is 10 to 15 years, then there needs to be some government intervention or incentivization to deliver this sort of supply uptick over a more meaningful timeline. And what the above sort of what I've just discussed sort of serves to highlight is that there needs to be a managed transition towards renewable energy. It's not to say that the world and commodities participants don't recognise that oil, gas, and in particular coal can no longer be part of the future energy stack, but the world needs to recognise that the solution is not an easy one to deliver, and that at present, with current technology, current supply, we're lacking the tools to do it in an effective manner.
Thanks. Thanks, Tom. One more question for you. What other difficulties and opportunities do you foresee arising as the world transitions away from traditional fuels towards a greener future?
As I was just talking about, there's definitely supply side issues with the materials required to put in place the infrastructure to move the world away from hydrocarbons. But I think it's also pertinent to discuss the fact that there are going to be supply side issues with the current energy stack. If you take a look at what's happening in Europe at the moment with the current energy stack and current energy crisis, energy crunch, as we move into winter, it sort of nicely highlights some of the issues that we will likely address globally as the world tries to move away from fossil fuels. Sort of key to understand that there's no easy switch to flick to turn hydrocarbons off and renewable energy on. And there needs to be an understanding that if the wind doesn't blow or the sun doesn't shine, there is still a requirement to generate base load power to keep the lights on. And that is not without its challenges at the moment with current technology and availability of materials. So if you take a look at what's happened in Europe over the last few months, we had a late winter in 2021, so around March, which required gas that would otherwise have been going into storage at that time of the year. Gas was then diverted to North Asia, China in particular, as their COVID recovery kicked in and industrial production picked up. Europe's recovery then started to play out a little bit, requiring increased gas demand within Europe. Through the summer months, there was very poor renewable generation. The sun didn't shine and the wind didn't blow, so gas utilisation stayed very high through the summer. And a small amount of Russian gas was diverted away from Europe, but that is largely still flowing. But Norwegian gas is at capacity, Dutch production has essentially stopped. So there is a huge gas shortage within Europe and no obvious renewable replacement at the moment. So if we move into a cold winter now, there's the very real possibility of rolling blackouts, which with a fossil fuel environment would be unthinkable. So as has been discussed by a couple of other people on panels and earlier, coal has been used to fill the void. We've seen multi-year, if not record highs on thermal coal. And that is a commodity that has been talked about being phased out, particularly in Europe, in the near term, not necessarily over the medium and long term. The same can be said of oil. Over the last few years, global reserves of oil have dropped from 15 years to 10 years, as investment in new fields has dropped almost 75%. So without a managed transition, about the fact that we can't move away from fossil fuels overnight, what we're seeing in Europe at the moment is likely to be repeated around the world in slightly different scenarios. But I think it's something that's very interesting to keep an eye on as different sort of scenarios play out over the next few years.
Right. Thank you, Tom. Elena, back to you. As you look at commodity prices, how important is the supply chain disruptions behind it? Do you think there was a tightness in the market due to congestion in shipping, maybe storage shortage, inland transportation bottlenecks? I would appreciate a short answer, please, Elena.
Yeah, sure. That's a good question, because indeed what we've seen this year is Russian supply, coal supply was constrained by the rail issue. So basically what was happening is just railway infrastructure capacity was not enough to bring enough coal that was requested in Asia. And we see a huge delays both in the overland deliveries into Far East and as well as delays into the port shipments, both in the Far Eastern ports and as well as in Europe. So this is not the This is like a background issue because they're building new infrastructure will require a lot of time, like 5 to 10 years, and it's not going to be resolved anytime soon. Right.
Right. Thank you, Elena. Back to Joel. Turning a bit to the broader macro picture, inflation is front and center when it comes to commodities, and the recent pickup in inflation has investors looking for cover. Do you think commodities such as iron ore, steel, or coal offer such protection? And do you expect some natural boost from higher inflation to commodity prices? Joel?
Yeah, definitely. I mean, we see this from a lot of our investors, that there's a lot of interest from institutions in accessing commodities as a hedge against inflation. Now, as everyone who's talked about on this panel has identified, there are a lot of idiosyncratic risks that are unique to each specific commodity. But as part of a diversified portfolio, and exposure to commodities more generally, I think is a fantastic hedge against inflation. I think in any commodity market, you have to look at what are the cost exposures of the marginal producer. And so in a lot of metals and mining markets, marginal producers have a high exposure to energy or to freight. And so any cost push from energy and freight will come into those marginal producers. We also see that things like FX can also have an impact, but there is a lot of idiosyncratic risk. It's not a perfect hedge on its own, but as part of a diversified portfolio, it's a good element that gives a good beta to inflation.
Thanks, Joel. Can we also take your view into 2022? Which commodity do you think will not perform and why? And the opposite, which commodity would you avoid and why?
Yeah, so I think Tom made a fantastic case for the bull case for copper. Copper inventories are very low at the moment, and they continue to test new lows. And there's a real problem on the supply side. So I would say that copper is a fantastic long. It's a hard to pick one. Platinum and aluminium are also both very interesting for their own reasons. On the short side, I hate to say it, but I think that in an environment where most things will probably go up, iron ore will probably be the weakest next year, or at least is most likely at this point to be weak.
Right. Thank you, Joel. We are running out of time, so I would like to thank all our panelists for their insights, Elena, and of course, Tom and Joel from Singapore for staying up that late. I hope it was a helpful discussion and hopefully provided some food for thought on the outlook for commodities. And with that, I will turn it now back to John in New York. John?
Thank you, Thanos. That was indeed very interesting. I mean, commodities remain a key part of shipping, and the outlook for commodities will most likely continue to have a significant impact on shipping for next year. So definitely a space to keep an eye on. And I would like also to thank our panelists, and especially Tom and Joel, for staying up past midnight in Singapore. So with that, we'll be back in 15 seconds with the final panel of the day. Welcome back. So our last panel of the day focuses on shipping decarbonization. So before you think that is a part of a long-term, slow-moving story, you have to consider this. In 2023, new regulations relating to carbon emissions for shipping come into effect. So this is not a trivial issue. The global fleet must comply, and the most obvious way to do so is to slow down. Slower speeds mean less emissions. Such a scenario can have an enormous impact not only on the freight rate environment, but also on potential congestion issues as the overall supply chain slows down. So we all know what happened in 2021 with congestion and the issues that brought to consumer goods and commodities. So is that something to focus on for the future regulation change? If 2021 taught us something, is not to disregard the impact that shipping can have on our daily lives, whether it is consumer goods, commodities, or energy. Shipping plays a vital role. We also believe shipping decarbonization will have a visible impact on shipping operations and thus future freight rates. So we're happy today to have with us a group of people that understand and follow the decarbonization space and could potentially provide more insight on this fast-moving space. But first, I would like to go to London and introduce Holly Brigett, who will moderate and also introduce our next panel on shipping decarbonization. As a reporter for TradeWinds, Holly has had a significant exposure to this fast-pacing sector and both the challenges and opportunities that come with it. So good afternoon, Holly, and hello to all our panelists.
Hi, John. Thanks for the intro. Yes, welcome to this session. We're going to take a look at all the decarbonisation technologies that are available to shipping and how they're being pursued in all the different corners of the industry, and also about some of the potential investment opportunities that could generate too. As John just mentioned, I am a reporter by day. I write for the shipping newspaper TradeWinds, and decarbonisation in shipping is such a huge topic for us. It keeps us busy on a daily basis. I mainly cover dry bulk myself, but you know, decarbonisation is so important to us that I'm starting to write that increasingly as well. So joining me on today's panel, we have Martin Okosh, who is Vice President of the Norwegian shipowner Torvald Klaveness, and he also heads up an initiative called Zero Lab, which we'll get into later. Martin has extensive experience from across the maritime industry and previously worked as a management consultant for ship owners, operators, terminals, equipment suppliers, people like that, and before joining Klaveness as their head of strategy and investments. Next up, we have Anthony Teo, who's head of the Americas region for RightShip, which is the world's biggest third-party maritime due diligence company. Anthony has more than 20 years experience in project management, business development, and strategic innovation in maritime. And before he joined RightShip in May, he worked for the classification society DNVGL for 19 years, that's a long time. Next, we have Daniel Caceres Larsen, who has been with Maersk Broker Advisory Services since 2017, where he is responsible for its decarbonisation offerings since they were initiated 18 months ago. Daniel previously worked on corporate finance projects, raising project finance for large energy infrastructure projects in Asia and Latin America. He has a master's degree in applied economics and finance from Copenhagen Business School. Very good. And last but not least, we have Simon Mockler, who's DNVGL's Business Development Director for Decarbonisation and Transformation in the Americas. He has worked for the Class Society for 11 years and helps its customers address the challenges of decarbonisation and meeting ESG expectations. So before we get into the discussion, I'm just going to set the scene for you all, because I imagine there's loads of people joining who may be newbie investors in shipping or just kind of have a basic understanding of the challenges that shipping is up against in decarbonising. The industry has set itself some pretty ambitious goals that have to be met over quite a short timeline. So it really is a race now to find the most commercially viable technologies so that ships can emit less carbon. But that's going to be no mean feat. Most of the world's deep sea going merchant fleet, which are tens of thousands of vessels we're talking about here, it currently runs on heavy fuel oil, which is the sludgy stuff from the bottom of the refining column. And it's estimated that commercial shipping accounts for almost 3% of all man-made carbon dioxide emissions. The International Maritime Organization is currently targeting a 50% cut in greenhouse gas emissions by 2050 compared to 2008 levels. But analysis by the think tank, the Global Maritime Forum, has found that if shipping is to hit net zero emissions by 2050, we need at least 5% of marine fuel to emit zero CO2 by 2030. So there's work being done already. In Europe, the European Union has proposed including shipping in its emissions trading scheme. And during the recent COP26 conference, 22 countries committed to establishing at least 6 green shipping corridors to be used by zero-emission vessels by 2030. In the private sector, certain big-name charterers like Commodity Trade Trafigura, Mining firm Anglo American have set their own targets to decarbonize the shipping activities by 2030. So in short, the will to decarbonize is there. The challenge now is, how do we do it? Hopefully we can get some ideas during this session. So let's start off by talking to a ship owner, Torvald Klaveness. Martin, if I can come to you, can you explain what is Zero Lab? It sounds technology driven, it sounds a bit scientific, but for the average guy on the street, what does it mean and what's it all about, just in simple terms?
Sure. Yes, Zero Lab is a business unit within Klaveness, and we are dedicated to exploring and developing new products and services related to decarbonization. So in many ways, we are like a startup in a 75-year-old shipping company in Norway. And our goal is really to make low and zero emission options available to our customers. Reaching zero emissions for shipping is a huge challenge, but we also see this as an opportunity for a shipping company to innovate. And where do we actually start here? Reducing emissions starts with measuring them, and that's at least what we think. So we just launched a new product for cargo owners to track emissions from their seaborne freight activities. And there's a lot of things happening around technology development in the industry. But at Zero Lab, we are actually just as much focused on business model innovation, especially on how can we connect front runners on the vessel and operator side with front runners on the cargo owner side, who do not want to wait for the IMO or other regulators to set stricter emission targets. And the key to achieve this could be green corridors, as you already mentioned, where there is sufficient interest from cargo owners and local governance to push for decarbonization. And we're also looking into shipping-specific carbon credits, or carbon insets, as we call them, as a way to fund decarbonization measures in the shipping industry.
Right. Okay. So you've done a lot of work so far. It sounds like. So based on everything you've done so far, though, can you tell us what are the technologies that seem to be winning the race so far? What are ship owners like Klaveness, for example, leaning towards? Obviously, this is probably going to change over the next couple of decades, but what technology for now is currently prevailing in trying to decarbonize shipping?
Yeah, I think it was, as it was mentioned already a little bit earlier today as well, in order to get to a zero emission future for shipping, we have to switch to alternative fuels for shipping. And here the discussion is currently mainly around ammonia and e-methanol, while some even dream of synthetic zero emission e-LNG in the future. Mm-hmm. But the common denominator here is going to be green hydrogen derived from renewable energy. So while green hydrogen is a detour for road transport, it will play a very central role for decarbonizing shipping and other sectors that can't be directly electrified. But in the short and medium term, there will be a lot of demand for technologies that can make current vessels more efficient. And we see a lot of technology companies gaining traction now, from anything from wind-assisted propulsion, air lubrication, that are basically air bubbles underneath the hull, making the vessel travel smoother through the water, and hull cleaning robots, making sure that the vessel sides stay clean. And this should be a clear opportunity space for VC funds, PE funds to really help these companies scale. And when it comes to the ship owner side, we actually just completed a successful private placement of $25 million on one of our subsidiaries, the Klaveness Combination Carriers, to fund energy efficiency initiatives on our fleet. So the interest from investors is clearly there on both sides.
Mm-hmm, mm-hmm. And it sounds like people are really trying to make their existing vessels run as efficiently as possible in the meantime before we get to these 2050, 2030 targets. Anthony, if I can turn to you now, RightShip, you are, as we've mentioned, the world's biggest maritime due diligence company. You specialize in ship safety, sustainability. How are you involved in helping to reduce emissions from shipping?
Thanks, Holly, for the question. I mean, we help customers in a number of ways, but essentially, the main thing is to help them differentiate their supply chains and vessel operators by comparing the relative efficiency of the world's shipping fleet in terms of environmental performance through greenhouse emission rating. So this rating is essentially a carbon design index for all ships using a kind of a standard deviation methodology where we calculate the carbon per ton per nautical mile of cargo that is moved on each vessel. And it allows our customers, to compare the vessels in terms of their theoretical CO2 emissions in their peer group of similar size and type. To break it down into a little bit deeper, so we use a kind of a A to G scale, A being the most efficient rating. And this rating system was developed and launched on our platform since 2012. So it's been in existence for almost 10 years now. This is even before IMO made CO2 design index mandatory in 2013. So far, we have about 100 over chartering customers using this GHG rating to identify and charter the most efficient tonnage. And this equates to about 3 out of 4 bets that we do on our platform on a year-to-year basis, which amounts to be about 35,000 bets. So it's not a small number. I would say banks are also using this kind of GHG rating to offer sustainable finance options for the market. And usually they go for A to C rated vessels. So going forward, we intend to enhance our platform and amend our rating system and complement what the regulation is going to implement in terms of carbon intensity. And we all know that regulations are very complex and ships are struggling to future-proof in this challenging environment. So we hope by creating a transparent and to demystify the regulation and differentiate the truly green vessels on our platform.
Mm-hmm, mm-hmm. It's really interesting that you mentioned banks. I mean, decarbonization is really going to change the face of everything, ship finance being one of them. So from your perspective, if you were to invest in one technology that would prevail in the future in order to decarbonize shipping, which one would it be and why?
That's a very tough question, but I would just break it down into, I won't answer your question directly, but I would say it's a matter of perspective. What you do today and tomorrow is very much what you see and very much depends on where you sit. There will be front runners and slow adopters embracing different technologies. But fundamentally, it boils down to 4 main factors. I would say technical maturity of the technology itself. I'll give you an example. 20 years ago, nobody dreamt of using LNG as fuel. But now, if you look at the data, there are a lot of ships that are running in the world that are running on LNG. And I would say most of the vessels are ordered today, new building, using LNG as a technology. Of course, the other caveat is how much of access and availability of these alternative fuel one can get. And of course, the development of regulations. We all want to push the envelope. End of the day, if regulations are not unified, it's not clear, it's very hard for movers to take the initiatives to push forward. I think last but not least is actually the financial model. How are we going to fund the technology? How would investors react to it? How would banks support this? I think end of the day, fundamentally is, will the public pay for this price delta? And I think that sums it up. It's not going to be a one silver bullet solution. So it depends on where you are.
Mm-hmm. And if you can fund it. Okay, let's move on to Daniel. So Daniel, Maersk Broker is a very well-known shipbroker. But it's only the other day that I heard about Maersk Broker Advisory Services. So you've set up this dedicated decarbonization team. What was the purpose of doing that? And what are some of the projects that you're working on that you can tell us about?
Yeah, so very quickly, Maersk Broker Advisory Services is in itself an advisory services. So the decarbonization team is within that. And what we've seen in the industry is that not a lot of companies have set up a dedicated in-house decarbonization. Challenge is huge. There's a reason that shipping is categorized as a hard-to-abate sector, because there are a lot of unanswered questions, and this creates a lot of uncertainty for a lot of our clients. So that's why we've set up a dedicated decarbonization team, where we want to assist all our clients and all the stakeholders in the maritime industry to initiate and to go along in their decarbonization journey. Some of the projects that we're working on is everything in between helping ship owners understand where they are right now, how is their fleet complying to current regulation and regulations that will come forward in 2023. But we also assist ship owners that already have set quite ambitious targets on how to succeed with these. So that's, in short, what we do in the decarbonization team.
What are you hearing from your clients? Is there, just out of interest, is there kind of a split developing between, kinds of ship owners who really want to get ahead of the curve on this? And is there another group that maybe don't care as much? What is the kind of level of demand there for help with this decarbonization?
Yeah, so I think in general, the topic of decarbonization is top of mind for a lot of people. Everybody acknowledges that it's more important now than it was maybe a year ago. That's also some of these external pressures that you were talking about. We split ship owners up in 3 stages. So there's the first step in just getting to know where you are, not really sure where you are right now. Then there's the next step where you understand where you are, but you need to develop the decarbonization strategy. And then we have very few owners in the last step, which is actually executing on the strategy and actually going out and building new vessels with some of these alternative fuels, if you would call them that.
Right. And what are the factors that are pushing customers to start thinking about decarbonization?
Yeah, so I think you mentioned some of them in the intro. So as we see it, one of the big factors is regulations that will be introduced from 2023. These are both international regulations, but also on a regional level. Shipping, the proposal including shipping in the EU ETS, which would in effect put a price on carbon for vessels trading in the EU. Then you see from the financial sector, a group of banks going together in these Poseidon principles, agreeing to reduce emissions across their portfolios. This will determine going forward who can lend money to which vessels and which types of retrofits. And then you also have very ambitious chartering companies or charterers that have put forward very ambitious emission reduction targets themselves. And in this process identified actually that ocean-going transportation makes up a significant amount of their Scope 3 emissions that they need to reduce this. So I think in the maritime industry at the moment, these pressures are not really strong. It's in a very initial phase, but we see these pressures becoming stronger going forward, which will increase the demand for the most efficient vessels out there.
Okay, right. Let's move on to Simon, because his company DNVGL has been doing a lot of work around decarbonisation, but I imagine there's loads of people out there who are watching this that have never heard of them or what they're doing. So Simon, can you just walk us through what exactly DNVGL does and what are some of the decarbonisation related topic projects that you're currently involved in?
Absolutely. So in a nutshell, DNV is a global and independent assurance and risk management provider. We work across a whole range of industries. We've been in the maritime industry for about 150 years as the leading classification society, meaning that we set technical and safety standards, and then we also verify compliance with international requirements on behalf of flag authorities as a recognized organization. In addition to that sort of core compliance role, though, we try and leverage the broad experience and the deep expertise that we've developed in our various industries so that we can advance both safety and sustainable performance throughout the whole maritime value chain. So one big part of that, for example, is we do an awful lot of autonomous and collaborative research for decarbonisation in particular. We've now published the 5th year running our annual energy outlook, which is our sort of prediction of what we think the world's energy mix is going to look like. And that has a dedicated subset within it, focused just on the shipping industry and what the shipping energy mix we think is going to look like over the years to come. And we use the insights that we gain through that research to then work with a whole range of ship owners and other maritime stakeholders to look at strategically what options are available for maritime decarbonisation. So examples of that could be, we would work with a novel technology supplier to approve their technological solution for onboard application. We work with authorities and even sometimes with ports and utilities to look at, okay, what might be the potential future demand for alternative fuels and technologies like shore power, so that they can use that to inform their investment decisions. And with ship owners, we will work to sort of forecast their fleet performance against the regulatory and commercial scenarios around emissions, so that they can then evaluate what's the most carbon robust investment that I can make today. Given the uncertainty that we still face in terms of technology, fuel availabilities a few decades out, what's the best decision I can make now that doesn't close too many doors and keeps as many options open to me so that I have a robust and sort of flexible asset throughout its life cycle.
Right. So with all the work that you've done so far then, and all the research that's gone into this, which are the technologies that you think will prevail or will be widely used come 2030 or 2050?
Same as Anthony, I'm going to dodge the question a little bit and hedge it. I think, in short, the next decade in particular is going to be incredibly uncertain. We know we've got a regulatory baseline, which is going to give us that consistent pressure. We may well see that customer and financier pressure is going to outpace that regulatory framework, at least the international one. But I do think we're fairly confident in predicting what mix of solutions we'll see out there in the short term. There will be a huge amount of operational rejigging and itinerary optimization. That's obviously going to have some quite big knock-ons in commercial and contracting considerations as well. So we need to see exactly what the charter party of the future looks like to be carbon robust. But on the technology side, I think we will definitely this decade continue to see a lot more LNG for new buildings, particularly dual fuel LNG gives you a very fuel flexible platform for the future. We're expecting that the return on investment calculation for a lot of well-known hull, propeller and machinery energy savings devices is going to change a bit now that it's not just fuel saving, but actually whether or not you can trade your ship on a particular itinerary, that ROI calc looks very different. And there'll be a much tighter focus on the energy efficient operation on board as well. I wouldn't say that any of that is new, but we will see a lot stronger, more focused application of the existing toolkit. If we start to look towards the end of the decade, we're quite bullish on the potential for emerging technologies like fuel cells and wind-assisted propulsion, but there are still big technical and commercial questions that both of those are going to need to answer before we can see wide-scale adoption. And ultimately, as Martin said at the start of this session, we're going to need a whole new generation of fuels, from ammonia and methanol to synthetic hydrocarbons and biofuels. The challenge we have today is that none of them are available in the volumes that we would need, and there are vast investment needs. So we're going to be going into a multi-fuel future, where different segments and different regional trades are going to be using different fuel mixes. And then just keep it exciting, then we've got pure wildcards as well, like onboard capture and storage and nuclear propulsion, which both could very well have application in selected segments, but there's going to be big public hurdles to overcome and big regulatory hurdles as well. Great.
Okay. Sounds difficult. But you've put me nicely onto we'll just spend to finish off, we'll just spend a couple of minutes talking about electric vessels. So in the US, there's been, obviously we have Tesla, We have a company called Rivian that did an IPO last month. It has a market cap of $100 billion and currently no product. There's so much excitement in the investor space around electric vehicles. If I can go to Martin, do you think that there's a future for electric ships? Do you think there will be something, the same level of investor excitement, for example, about an electric shipping company as there is around vehicles? Vehicles.
Yeah, shipping is in general not as close to the end customer as the producer of cars. So I don't believe we will see the same mega IPOs here. And direct electrification of deep sea vessels is not really realistic. We have done the math, and while space and weight are obvious issues, the cost is an even bigger deal breaker. We would need to pay around $900 million to equip one of our ships with batteries, and that's 20 times the cost of the ship. So even though you can divide the cost by 20, it's still too much. So you're not going to see that. Short sea is a different story, and if we want to find some things like Tesla, maybe leisure shipping is something you can look at, because we start to see the same tendencies there as the early days of Tesla. Today, the electric leisure boats are slow and clumsy, or high-performance machines out of reach for the average consumer, much like the first Tesla Roadster back in 2008. So maybe this market takes off when there's a Model 3 for leisure shipping.
I'm so focused on commercial shipping day to day that I never even have considered the potential for electric leisure vessels. That's so interesting. Simon, can I get your take on this very quickly?
Absolutely, and I mean, yeah, Martin's spot on. The economics are almost impossible to make work for deep sea. Short sea, there are certainly applications where it works. I mean, we now have the Yara Birkeland starting her trial demonstrations in Norway. The ferry segment is certainly an area where electrification has huge promise and a lot of existing uptake. There's also, though, other than full electrification, battery hybrid, I think, is something that we expect to see a lot more of. And that's probably going to be the largest application of battery tech in maritime for us. You can start with cargo gear operation in port, and then maybe into the 2030s, we've got, economics and battery capacities to the point where we can have zero emission maneuvering operations within the breakwater. For a large number of segments. So we will see it, but it ain't going to be the be-all and end-all solution for sure.
Brilliant. Okay. Right, everyone, we have 1 minute left. So we're going to go around and I'm going to ask you, and you have to give me your gut feeling answer or whatever you feel. Fast forward to 15 years from now, looking at the shipping market, what means of propulsion or fuel source do you think that that many new built ships, or the majority of new built ships, will be using? Let's start with Martin.
I'm a strong believer of ammonia as the future fuel. It's a real zero emission fuel. Of course, you can look at synthetic fuels such as e-methanol, e-LNG. They sound green and clean, but they need carbon. And I don't believe in a future where we capture carbon for then releasing it again as a fuel.
Okay, same question to Anthony. 15 years time, what are new building deliveries going to be running on?
So I think most ships would be optimized from a hydro and aerodynamic perspective. Alternative fuel will be used. I agree with Martin, but only when renewable has excess energy to convert this into liquid fuel. Thank you.
Okay, Daniel, what do you think?
I will echo the rest of the panel. I think green ammonia, the vessel will be more fuel efficient than it is today, but we have to make sure that the supply is there, and that's a huge challenge as well.
Mm-hmm. And last but not least, Anthony, what do you think?
I think I just said.
Yeah, I'll assume that was for me.
I'm sorry. Sorry, I've lost my train of thought. Go on.
A very fuel flexible design. I think we're still very likely to see a dual fuel engine that's capable of burning both liquid and gas fuel sources. I do think there will still be a significant share of hydrocarbon in the mix, whether synthetic or bio-based, but then we'll have segment and specific trades opting for ammonia or methanol solutions, depending on availability and sort of practicality. And I think we will see an awful lot of ships that will change fuel source or primary fuel source, not just through their lifetime, but even in a year. I think we will see that you will trade on different fuels depending on where you are in the world and what itineraries you're on.
Okay, right, that brings us to the end of the session, I'm afraid, everyone. Thanks to all of our panelists for such a fascinating discussion, for all your insights, and thanks also to Breakwave for having me along as well. With that, I'm going to turn it back to John in New York. So thanks a lot, and see you later.
Thank you, Holly, and of course our panel for their insights. I think, as you heard, uncertainty brings opportunity, and I think decarbonization will play a significant role in shipping, but also provide immense opportunities for the years to come. I mean, if one thinks what happened with electric vehicles, and I will mirror basically Holly's opinion on that, imagine what will happen in shipping with some 100,000 vessels around the world that have to comply with regulations. And as a friend of mine says, if shipping was a country, the emissions will be the size of Germany's. So I think innovation in the space will reap significant benefits, and investment opportunities will obviously appear for the years to come. So thanks again to Holly. Enjoy for the rest of the day. And that was our last panel of the day. So obviously I would like to thank all our panelists that make this event possible. I hope you enjoyed our discussion and become a little bit wiser of those very important industries when it comes to the global economy. So that concludes our Breakwave Day. Thank you all for joining us, and wish you all Happy New Year, and looking forward to continue the discussion for the years to come. Enjoy the rest of your day.